The biggest down days usually happen just ahead of intermediate lows. Yesterday was a perfect example of that. Nvidia delivered a standout quarter, and the jobs report arrived. The Nasdaq jumped 2% at the open, but then it reversed completely and finished the day in the negative. That kind of sentiment flip really confused traders, making them wonder why the strength just couldn't hold. Selling into strength often creates reversals when intermediate cycles are declining. Professional money tends to use rallies as exit opportunities, not to participate further. As the market stalled on the upside, traders decided to sell into that strength. Stop-loss triggers ended up breaking early buyers. When intermediate cycles are declining, momentum rallies just lack the structural foundation needed for continuation. The long-term cycle is beginning to weaken, and the Nasdaq is giving us an early warning. It's still bullish as long as it's above that 80 threshold. But remember, this is a warning, not a confirmation of a trend change. Premature defensive positioning can actually create an opportunity cost. We're watching closely to see whether this weakness continues and progresses, or if it stabilizes and bounces, confirming the bull market still has strength. So, counter-trend rallies often fail when intermediate cycles haven't turned yet. Markets tend to treat these bounces as selling opportunities rather than buy signals. Short-term momentum usually heads right back to those lower zones after a failed rally. But here's the thing, the intermediate cycle can get very close to turning. Once it finally stabilizes, the backdrop really shifts, and rallies start to become continuation moves where strength actually holds, not just reverses. If you're ready to trade with more discipline, clarity, and confidence, and maybe even predict the market days or weeks in advance, join the Market Turning Points community and visit stockforecasttoday.com.